Well, good morning, everybody, and welcome to the June session of Dashboard Diagnostics. My name is Mark Robertson. I'm joined here by Lori Fredrickson of Bivio, and we have a couple of the members of the Dinamat Investment Club out of hailing from New Jersey/New York. And I was telling the ladies a few minutes ago that are members or participants in the Dinamat Investment Club that their portfolio is so cool. I think all of you are in for a bit of a treat because there are so many wonderful lessons and things that we can talk about with the club. We could do this for quite a while today, but we are going to focus in on some of the main stuff that I see that's kind of cool. The purpose of these sessions is to basically dive in, use a real portfolio to take a look at what type of lessons, what type of stories can we tell, and as I have Lori to thank for getting us into doing this a couple of years ago. We've been doing that now for a couple of years, I think, Lori. Is that correct?
Yeah, I think it is a couple of years now.
You know, and Lori, when you first suggested this, I kind of had some trepidation and wondered, would we have to go out there and hunt down things to do and all that kind of stuff? But we have been just absolutely dazzled with the clubs that have turned in portfolios, and sometimes clubs will actually operate under our witness protection program. But the bottom line is, what we have discovered is we don't have to go out there and hunt for them. They come to us, and without any effort at all, what we've found to be true is there's basically a story, and it's 99% of the time it's a positive story in virtually every portfolio we've touched. And
to me, it's like visiting different parts of the United States. There's always something interesting wherever you go. You don't have to go always to a big city or anything. It's like now Robert Hayes is telling me that they have lavender fields in the Pacific Northwest, which I had no idea.
Well, now you'll be on your way out.
I don't even have to go to France.
Again, that same thing holds true. I mean, what we also find is local favorites. One of the things we'll be talking about here in a few minutes is a relatively unknown company by the name of Valley National Bank. And I'm pretty sure I'd be willing to bet that it's kind of a local favorite for the ladies. And we also see that from time to time as we go all around the country, either in person or with these national webcasts, actually global webcasts. We have people joining us sometimes from Australia, China, Singapore, Hong Kong the other night. Some pretty cool stuff. So anyhow, let's go ahead and dive into this. I couldn't resist the picture of the lady hauling the dynamite there. That's not intended to say anything ominous about the club. I think it's just kind of a cool picture. And as many of you know, for several months now, especially since Hugh McManus did his session on how human psychology, the nature of fear and that sort of thing can get in the way. And just this general notion that, what are investment clubs all about? And Nancy said it a few minutes ago. They formed their club nearly 28 years ago on a foundation of education. And it really is, investment clubs are intended to be educational. It's supposed to be an opportunity for people to lean on each other, and that's why we like the campfire scene. Basically, nothing resonates more than coming together around a campfire, and also campfires are there to keep the predators away. The third picture on your cover slide we're going to have some fun with. Many investment clubs out there these days, thanks to the blessings of Apple Computer and its achievements, have achieved relatively large positions with Apple in their computers, and we're going to spend some time talking about that. And we'll also get to know a little bit more about the ladies here in a minute. One of the things they were sharing in the pre-session is that they cashed in a little bit of the investment club and all went along on a trip to Paris and Normandy, took a river cruise in France, and that's why the last picture celebrates that notion. So we'll be taking a look at these kind of things as we go forward today. First, we have to get the legal entanglements out of the way. We are going to talk about real companies. The ladies have been gracious to provide with a real-world portfolio, so we'll be talking about real companies, offering opinions. Everything we do here and everything in the modern investment club movement is about education and demonstration. There's no investment recommendation intended by anything that we do here today. Please, 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 always do your own homework. All right, I'm going to start with a little bit of a Saturday morning rant. It's kind of crisp out there. We've got the lady with the jogging with the dynamite, toting the stick of dynamite there, and of course the campfire scene. But this is an article that's only a couple of days old that somebody shared with me just a couple of days ago about why individuals should not buy or invest in individual stocks. And you can find this type of fare all the time out there. Everybody from John Bogle, who I admire passionately and dearly, to a whole bunch of people that basically don't believe that common people like us can invest in stocks. And again, you know, what are investment clubs all about? Again, this comes back to we really are about keeping a long-term perspective, establishing that perspective, and teaching the analysis and management of portfolios, and basically proving. We're going to take a look at some very interesting performance statistics as part of the session here today. But we think there's just volumes of evidence that people can pick individual stocks, and in fact, it can be a very powerful engine for successful performance and retirement and all that kind of stuff. And who knows, even things like a trip to France. Let's get specific about trips to France here for a second. Just spend a little bit of time talking about the club history. And again, Nancy, feel free to jump in. The club has been, it's going on 28 years old. It was formed with 4 ladies back in that time frame, and it has actually ranged between 4 and 14, is my understanding, over the last several years. And they have a pretty solid track record since 1994, basically matching or keeping up with the market. And again, we're going to come back to that and explain why that is exceptional, because it probably doesn't feel like it just looking at that number. We really want to put that in context. You'll hear us talk about context and perspective an awful lot, but you know, one of the things that I think we see with the clubs like this one is, you know, just again getting together and going on a trip to France. There is a social element to it too. Definitely a friendship and social element, and a real tendency to lean on each other and learn from each other. Is there anything you'd like to add to that, Nancy or Lori?
What the relative return makes me a little nervous since 1994.
Yeah, that's how far back apparently the accounting records go with in the club accounting record keeping, and we are going to come back and put that in greater perspective. And but keep in mind that those numbers are actually probably better than they look. And again, we'll put it in better perspective here in a few minutes. Anything else? And by the way, for those of you that missed the pre-session, the ladies are thinking about returning to Paris. And is it
or somewhere else.
Or somewhere else. It's definitely a good thing to keep in mind. All right, let's go ahead and march on. This is basically what we're talking about here today, and we're going to basically take and talk about portfolio design and management and how they really are joined at the hip, and talk about a few things, some best practices, take a look at the portfolio, talk about a tiny bit of asset allocation type concepts, because this club has been around for quite a while, and you'll see that they actually do deploy a little bit of that type of stuff. They're at least dabbling with it. But again, just want to reinforce this notion of investing being a long-term journey. It's a marathon, and that a lot of the things that that lead us in the modern investment club movement to success in investing is to recognize what is important. You know, for nearly 7 decades, we've come together to reinforce what really matters when it comes to identifying excellent companies, high-quality companies, how to identify when they're on sale, all those type of things, and then also have some notion of targets or objectives. This is much of what we do at Manifest Investing. The ladies are not that familiar with Manifest Investing. Manifest Investing is basically the business I founded when I left Better Investing magazine, and it's basically based on witnessing the success of many successful individual investors and investment clubs, you know, in my role as senior contributing editor, and just these very powerful lessons of what really matters. You know, what did George Nicholson, the grandfather of the modern investment club movement and one of the co-founders of the National Association, what did they teach us about investing, what really matters, what to focus in on? And for me, I think what it really does is, you know, like a laser beam, helps us to shut out all the chaos and noise. And again, the dipstick is a perfect example of that. You know, if you're going on a journey, you want to have the right amount of oil in the engine, And the same thing can be translated or extrapolated to investment club or individual portfolios. You know, what's important, and then measure it. And that's what you see on this slide here. This is our core slide for any portfolio as we do a dashboard diagnostic. We'll talk more about dashboards here in a second. But what we do is we take the overall portfolio and try to come at it from a very big picture perspective. And right now we're talking about a stock market. The median or average projected return, or the return forecast for any stock right now, is hovering right around 10%. Just as a frame of reference, a couple months ago that would have been 7 or 8%, but the market has gone down a fairly significant amount. So we use that as a guide. If the average stock is out there at 10%, we want to obviously do average or better. The three most important characteristics you see graphed here are the return forecast, the projected annual return, the quality of the holdings, and the overall growth, the overall average growth rate of the portfolio. And the Dinamat Investment Club checks in pretty strong here, maybe a little bit light on overall return forecast, but not bad. So as they think about going forward with the portfolio, simply what they want to do is just search for opportunities to close up that gap. Again, this is our target range for return, 15 to 20% right now, based on where the market is right now. And again, the club is within striking distance, very close to achieving minimum levels there. Quality, very important. And this is what protects us during corrections and bear markets, deeper corrections, all that kind of stuff. The quality rating of the portfolio is 75, and that's right in the heart of the target range. Think dipstick. And again, in my role as senior contributing editor and getting to look at those piles of portfolios in the portfolio contest, I got to witness, you know, clubs that got into trouble, clubs that excelled, and what we found is that the clubs kind of hung out in this range when it came to the overall quality of the portfolio. We're in pretty good shape to face whatever challenges Mr. Market tends to throw at us from time to time. And then we're going to take a look at this one in greater detail in a few minutes, but again, you want to have enough smaller and medium-sized companies in your portfolio so that you have enough growth. Well, what is enough? Enough growth, as defined by Mr. Nicholson, was somewhere in that 11% range, give or take. And this is an area where the ladies can probably do a little bit more. Want to find some smaller, faster-growing companies to boost this number just a tiny bit. It's not bad at 8.8, but again, the average, more successful investment club puts themselves in a position to increase the probability of success by having enough smaller companies so that number is closer to 11 or so. Again, give or take a point or two. So again, this is the target range we're talking about, and it's the only one that's a little bit short. Again, a fairly common characteristic in investment clubs, not quite as bad as it was 10 years ago. 10 years ago, it was common to find clubs with overall growth rates in the 5 to 6% range. And in fact, I was a member of one of those, and we got our heads handed to us during one of the corrections about 10 years ago, recession, I should say, about 10 years ago. So that's where you want to be careful and, again, have enough of that distribution. Let's take a little bit closer look. We're just going to look at a fraction of the dashboard. We'll look at the whole dashboard here in a second. But what we basically do is take the entire set of holdings, stack them up, and take a look at the return forecasts, again, according to the analysts out there, and look at them from highest return forecast, projected annual return, to lowest. So the highest return candidates in the portfolio right now are some of these technology stocks, a couple healthcares in there also. And then we left out a few companies in the middle. The ones that have lower return expectations right now range from Verizon, Duke Energy, and these are fairly consistently low, so we want to talk about that here in a few minutes. International Business Machines has had a really nice run, but it ranks as one of the lower return forecasts in the portfolio right now, and it's also a pretty good chunk of the portfolio. So these are just some of the things that we notice as we go through the portfolio as we're thinking about, well, how would I basically raise the overall growth forecast? And the answer is by finding companies that have, again, perhaps a little bit more growth, perhaps some smaller companies, and do some switching or replacing or adding to the portfolio to bring a little bit more growth, while at the same time closing up that return gap. So again, identifying higher return candidates along with maybe a little bit more gusto when it comes to the growth end. All right, everybody who wants to take a look at the ladies' portfolio in greater detail, here it is from top to bottom. They have 21 or 22 stocks. These are actually, again, ranked from highest return forecast, measured by their projected annual return, down to the lowest. And again, just a great portfolio. We're going to be taking a look at sector diversification here in a minute. Overall growth, again, is not that bad, even though it could stand to be just a little bit better. Pretty good stuff across the board, very high quality. Couple of frisky experiments in here. We actually, because my wife works for Chrysler, this company is a four-letter word in our house. But it's been an interesting run for many people within our community that are willing to invest in a little bit less traditional company. And very few of us in the room would consider Ford to be a core investment, but some of us are not afraid to speculate a little bit with non-core, and we'll be talking about that in a little bit more detail in a few minutes also. But from top to bottom, my gosh, it's diversified broadly. Obviously, some of these companies like Apple have done very well for the ladies. Again, a really wide berth here, and we'll dig in and take a look at some of those in greater detail here in a few minutes. Let's talk about one question that we get from a number of investment clubs, and that is, how much is too little and how much is too much when it comes to some of these positions. Take, for example, Oracle at 1%, 1.4% of total assets. There's a couple of others in here. Ford is relatively a small position. Valley National Bank Corp is at 1%, again, relatively small. And then at the other end of the spectrum, we have these guys at 24% of the portfolio. There's another one down here that's pretty hefty compared to the other stocks in the portfolio. And again, the question is, how much is too much and how little is too little? And for a portfolio that's got basically 20 stocks in it, this is our general guideline. And again, emphasis on the word guideline. This is not hard and fast rule, and you certainly wouldn't just run out and act on it based on what you're seeing here. But as a guideline, it makes a lot of sense to kind of keep the position sizes between 2.5% and 10% for a 20 stock portfolio. When would I begin getting concerned? My general rule of thumb is anytime it's 2 times this number. So anytime for a 20 stock portfolio, when you start getting up in the 15 to 20 range as percent of total assets, I start to at least scratch my head and start thinking about possibly acting on that. And we'll be talking about Apple here in a few minutes. Same thing down on this end. If you've got a company that's less than 1% of total assets, and and it knocks the cover off the ball or hits a home run or fails, either way, it doesn't have that big of an effect on the portfolio. And all of us know that we basically spend about the same time and energy on most of the stocks in the portfolio. So again, it's kind of a matter of personal taste, but I kind of like to keep the positions at 2%, 2.5% or above. So that's just a general guideline, and again, it's based on the number of stocks in the portfolio. If you're in a club or an individual investor that has 12 stocks, your numbers are different. So that's average position size, and again, emphasis on the word guidelines. Here's where that comes from, just as a point of reinforcement, academic reinforcement. The benefits of diversification by number of companies basically start to arrive somewhere around 12. And by the time you get out in the 20 range, they're relatively flat. I mean, you're not taking any risk out of the portfolio by adding a whole bunch more companies going this way. But you can see that obviously all eggs in one basket, more risk, and an infinite number of eggs in the basket, and not such a bad situation. All right, let's take a look at the sector diversification of Dinamat. I have to admit, I've looked at literally thousands of portfolios. I don't remember the last one that had every sector represented. So, I mean, this isn't really that big of a deal. It's not something you should try to do, but when you end up there, it's fine. I mean, you've got good representation across the board. There is a little bit of a concentration here. I wouldn't rush out to buy any more technology companies in the near future unless you had a really, really powerful reason for doing it. But again, our perspective on sector diversification is it's important, but it shouldn't be the driving force behind the portfolio. In fact, probably not a driving force behind the decisions made for the portfolio until you get a situation where you have too much technology, too much of a single sector. As a case in point, I was a member of an investment club that at one time had 60 to 70% in financials. And that club got hurt pretty badly when the financial sector madness hit a few years ago. And so, again, we know better than all eggs in one basket. Again, don't obsess over it. Go where the opportunities present themselves. But I did have to take my hat off to you guys for having across-the-board representation by sector. Don't see that very often. Here's a look at the size diversification. Again, at Manifest Investing, we classify any company as large whenever its growth rate is less than 7%. So less than 7% lands it in the blue slice of the pie. Again, our target for this is somewhere around 1/4 of the portfolio, 25% of the holdings. So there's a little bit of a concentration in larger stalwart companies. That's fine. You just want to be watching for opportunities, perhaps reduce that, perhaps shift them over as time goes by from larger into medium-sized companies as you get opportunities. Pretty good representation on the smaller side. Again, we define small companies as companies that are growing faster than 12%. So you only have to remember two numbers, 7 and 12, to classify the general size of a company by its growth rate. So again, taking a look at this, not bad. But again, if I'm out there shopping and acting on the Dinamat portfolio, if you guys gave me the portfolio and said, Mark, it's yours, I would basically be trying to watch for opportunities to steer some assets from larger companies to those more medium-sized companies. Again, in the process, bumping up the overall growth rate of the portfolio. All right, why do we obsess about this one so much? This is, again, a pretty powerful slide, and it helps for anybody who's having trouble convincing their partners that it is prudent to go after the smaller and medium-sized companies, because we hear so much about the big ones that are on the tube every day or in the paper or in the news. It's important to get out there and find the smaller-sized companies too. I went back to the beginning of the Dinamat Club, going all the way back to 1984, and what you see here is a graph of the S&P 500. It is shown in the red. This is the ticker on Finance Yahoo. So the red is the S&P 500, and again, the S&P 500 is virtually completely all large companies, in some cases mega large. And you can see that over the lifetimes, again, going back almost 28 years now, over the lifetime of the club, the return from the S&P 500 has been 8.1%. This was a wonderful period here to be in large cap companies, kind of the golden age of the investment club movement. But then here you see what is commonly referred to as the lost decade. The S&P 500 has basically gone nowhere. I mean, it shot up, shot down, shot up, shot down. But the end result is it's basically gone nowhere for the last approximately 10 years. Now, the thing to take away from this chart, this ticker symbol is for the value line arithmetic average. The value line arithmetic average is the 1,700 companies that are in the black book or the green book, depending on how old your copy is at the library. So it's not 500 companies, it's 1,700 companies, and it's an all of the above collection of small, medium, and large. And you can see that just by investing in small, medium, and large, all of the above, this number shoots up to 11.6. So this difference here is not insignificant between the two endpoints on here. Again, boiling it down into per year terms, 3.5% per year, just by making sure that you invest in small, medium, and large. And what's kind of fun is if you take and set the S&P 500 component of that aside, you find out that the performance of the small and medium companies is literally 5 percentage points. That's 500 basis points more than the S&P 500 during this 28-year time frame. So again, it just re-amplifies the point that you want to make sure you have small and medium companies as part of your portfolio design and management efforts. Now, granted, sometimes when you're investing in some of those smaller companies, you do get some of this, kind of like tiptoeing through minefields. But again, that's what it's all about. Don't overly concentrate in them, but don't ignore them, don't avoid them, and do your best to understand them. And again, kind of coming back to what Lori said about the clubs we experience and witness and share stories with from one end of the country to the other, It's an opportunity to find the 2 6s out of Pittsburgh, or the Middleby's out of the Chicago suburbs, or any number of companies from all over the map. But it can be tiptoeing through the minefield a little bit. With that, Lori, do we have any questions on the tote board or anything that people would want to go into before we progress with taking a closer look at the portfolio?
I don't see any. I think we're okay.
Okay, let's go ahead. And again, if anybody has any questions or comments, please go ahead and enter them in the questions tab or raise your hand. So let's go ahead and dive into some of the portfolio itself. What I've gone ahead and done here is display the segment of the dashboard. And again, it's from top to bottom, best return forecast at the top, weakest at the bottom, just so we can kind of dive in and take a look at some of these that are down on the potential selling or switching end of the portfolio down here. And let's talk a little bit about this portfolio position in international business, IBM, because it's, again, 11% of total assets, pretty good chunk of the portfolio. And basically want to challenge it a little bit and make sure that the numbers add up. Is it really a company with a perspective of, mid-single-digit growth rates? So what you see here is your visual analysis from SSU-based stock study for IBM, and you can see that we're focusing in on, fairly recent history, this last 3 or 4 years of actual results, along with a couple years of analyst forecasts. And again, we don't need to go into it now, but we believe at Manifest Investing that it's very important to consider these analyst forecasts. They're readily available at Yahoo for both sales and earnings, and make sure that basically the wheels aren't coming off or the lug nuts aren't coming loose on any company that we study. We see that's certainly not the case with IBM. Very powerful earnings track record going forward. You can see here, though, from the growth trend that is pictured here, it is a fairly modest, 4 maybe 5% type growth company. Again, not the end of the world. This is a large company, so we wouldn't expect to see a whole lot more growth there. One of the other things that we counsel clubs and individuals to use as a good second opinion is ValueLine, valueline.com, and go in and take a look at the low return forecast for any company, and always kind of reconcile that versus your own studies versus what you see at Manifest. And you can see here that the 5% on the low side actually reconciles pretty well with the 6.6 that you see here. Again, that's an analyst consensus forecast formed by us at Manifest, but that also includes input from places like Morningstar, S&P, and a few others, along with a traditional stock selection guide. And you can see that the two compare pretty favorably. So again, IBM is not positioned to be incredibly exciting over the next few years, and it's, if anything, it's in the hold range. And again, depending on the needs of the portfolio, again, this portfolio doesn't need a whole lot. If that were to drift down towards, I don't know, 2 or 3%, I'd get really tempted to replace some of that IBM with something else up here at the top of the chart, or perhaps even go outside the portfolio to find a promising small company or medium-sized company outside the portfolio. So again, IBM, moderate growth, very mature growth, solid company. I'm not saying it's not a good company. It's an excellent company, but one that could be potentially considered for replacement if you're trying to raise the overall return of the portfolio. Let's go ahead and talk about Verizon, another one down here at the bottom. Again, relatively modest or mature growth rate. Not a really big position in the portfolio at 1.6, and again, we talked about maybe trying to bump that up whenever conditions merit it. They merit it when they're up at the top here. This is a position that probably deserves to be increased. You have to keep that technology concentration in mind as you have those thoughts. But again, here's Verizon. Again, fairly mature, fairly moderate growth expectations, and fairly stable, relatively unexciting earnings expectations. Kind of a cool picture in terms of that thing that we always say about price following earnings. You can see that as the earnings basically oscillated up and down, you can see the same trend in the earnings down below here. So they do follow earnings. In this case, this is a case where ValueLine is a little bit more optimistic. for Verizon. This 13% does not compare quite so well to this 5%. And again, the difference is Standard & Poor's and Morningstar and a couple of the other places that we check are much more pessimistic or slightly more pessimistic about Verizon than Value Line is. So just something to keep in mind. That's why we encourage especially experienced investment clubs to gauge and check in with a number of sources as you form and build your own conclusions about the merits of any company as an investment. All right, we can't go too much further without talking about the elephant in the room, right? This is true for many investment clubs. Don't you just love that picture? I think we might have to use that one again. I might actually have to see if we can't get widespread rights to this one. When I first looked at it, I thought the elephant had big sunglasses on, but he doesn't. But yeah, this is about the elephant in the room. Thanks to the success of Apple, you have a situation where it has grown in many investment club portfolios to be a dominant position in the portfolio. And this is pretty true here at 24.4% of total assets. Again, unless and you guys are adding money to the portfolio, you can watch this as time goes by. But if it hovers up there, and again, looking at it from the perspective of giving the portfolio to me so I can make my own decisions about it, I would begin thinking about, even though it has such a high return forecast, the outlook for Apple is quite strong, I might look for opportunities to essentially take a little bit off the table, so to speak, or to take that position size down and bring it back into ranges closer to 10 to 15%. I would never, ever rush to do that. Take a look at the overall outlook for the portfolio, take a look at how much money is coming into the portfolio, a variety of things, but we'll talk about those as we go forward here. But again, it's a situation that many investment clubs find themselves faced with. One of the things that we like to talk about, and this is actually an excerpt of a presentation I did fairly recently on is Apple as vulnerable to what happened at Qualcomm 10 or 15 years ago. And at Qualcomm, what we basically saw happen in the late 1990s was a shift in the business model so that their profitability as measured by their profit margins went from low single digits up to what you see here. Again, a big shift in the business model itself. And a lot of the analysts were having a hard time figuring out what was going on here 10 years ago. That's why we had such a disruptive price moment in Qualcomm 10 years ago. I was in an investment club that had a massive position in this company. And long story short, we didn't sell as much of it as we probably should have when the price went up 500% over the course of a few months at the end of the 1990s. Same thing is kind of going on these days at Apple. We're going from those days of yore, years ago, when they were relatively low margin, just a computer business, and then they reinvented music and all kinds of other stuff to make Apple basically indispensable to many people. And you can see now that over time, the net profit margin, the profitability of Apple has gone up to these incredible levels, up in the 25% range, and they're projected to stay somewhere in that range going forward. They'll have a competitive battle to do that, but they have achieved awesome things, and that is basically behind the huge surge in price and interest in the company. Let's talk a little bit about what can happen to companies, even great companies. And this is something we spent some time talking about a few weeks ago. We talked about this thing called the death cross. We'll talk about it here in a few minutes, but we just want to point out that companies like Apple are vulnerable to fairly significant price corrections, as you can see here back in the 2008-2009 timeframe. Pretty healthy drop in price. You just want to be aware that that can happen and what you might be able to do to position yourself to watch for that if you use stock watchers in the investment club or if you have it as a personal holding. We refer to Wall Street analysts and institutions as rhinos. The short version of that story is because rhinos have a relatively short field of vision. They can see approximately 30 feet, whereas they've been clocked at land speeds of up to 45 miles an hour. And then the other thing that makes this a term of affectionate endearment is a group of rhinos is known as a crash. Well, the only thing you need to take away from this price chart, and it's basically, we think of it as kind of keeping track of the collective herd. We'll talk about this relative strength here in a minute, relative strength index, is these analysts and Wall Street institutions that are known as rhinos, they use a thing called moving averages to basically keep track of the price trend of any stock. And in this case, what I've shown here is a 50-day moving average versus a 200-day moving average. 50 days basically representing kind of a quarterly type thing, 200 days representing kind of a trailing year type thing. And the only thing you need to know is that the rhinos watch this. And anytime the red line, the shorter term moving average, crosses through the blue line, the longer term moving average, the rhinos get the heebie-jeebies. They get skittish and they begin misbehaving, dumping the stock, and that sort of thing. So, and this has been a fairly reliable thing over history, so you want to watch for this thing known as the death cross, as showed up here in late 2008. Here's a closer look at that death cross along with what happens when, as we say, rhinos or elephants sneeze. This is a look at literally going back to October or Halloween 2007 and taking a look at the next 18 months or so as we went through that recession period. And basically what you see here is, the volatility in the stock price, but here is that crossing moment with the blue line in a downtrend where the stock price literally went from somewhere around $200 down to the 80s, literally overnight, a 60% price drop. And again, just to make sure you understand how extreme, I mean, this happened in the course of literally a little bit more than a month. So 60%, most of that 60% in approximately a month. So that's the type of thing that you take a company like Apple and you're protecting yourself against. The scenes from Jurassic Park in the movie where the friendly Vegosaurus sneezes on the kids. For those of you wondering about this death cross thing that I've talked about, again, whether you believe it or not, again, in the investment club movement, we encourage everybody around us to understand, what are the forces at work in the stock market? What do the rhinos see? What are they watching? Why do we care about it? Then you can decide what you think of it and how you use it, but it's a reality. If they're all watching this and they do tend to all rush for the exits at the same time, it's an absolute reality and something that any shareholder in Apple is well advised, any company is well advised to watch for a little bit. This is the explanation or the definition as described by Investopedia, investopedia.com. I would encourage you to go there and look at some of the background materials, but this is what it's about. And again, they're using a 100-day. I used a 200-day average. But again, though, the rhinos look at the stuff, and that's all you need to take away. And they not only look at it, they act on it, and they act in a group. They act in a herd. Let's come back and put it in present-day conditions. This is Apple going back approximately 2 years. Again, to give it a frame of reference, the value line low forecast, low total return forecast is 16. So there is no hurry here. This is a company that has pretty solid projections. The fundamental forecasts for the company continue to be very positive, and no need to hurry and run from this one. Obviously, if that was 6 or -6, it would be a completely different picture. But one of the things I want to propose is, again, if it were my portfolio, I would be watching for these opportunities that I refer to as patient whittling. And again, at 24% of total assets, what I would be inclined to do is watch for these moments in time when the relative strength index, and again, you can go to stockcharts.com, here's the address. Anybody who's not familiar with this or Manifest subscribers know that you can search on the term relative strength index in the forum. Basically, relative strength index is a measure of momentum, measure of price momentum for a stock, and it can also be thought of as an implementation of support and resistance concepts. Again, that's important when it comes to what the rhinos tend to do as a herd or as a crash. In this case, we watch for relative strength index readings that are either greater than 70 or less than 30. In the case what we're talking about here, when it comes to this whittling, we're looking for relative strength index opportunities that are greater than 70, as is shown here. as shown in this circled area, because those can be opportunities to take and do some whittling. And again, taking a 24% position, perhaps selling a few shares off on the side, taking a look at the tax impacts, perhaps balancing against some tax loss positions, etc. You guys all know the drill. But again, notice that anytime one of these overbought conditions, here's another one back here, here's another one here, anytime we see one of those, we simply admit to ourselves we don't know where this price is going, but we do say to ourselves after each one of these type of events that we would not be the least bit surprised to see either a flat spot or a downdraft, either a flat spot or a downdraft in stock price. So if that's true, this type of an extended period where the price has kind of gotten ahead of itself, you'll hear the talking heads or the gurus on CNBC talk about potentially overbought. Simply it's run too far too fast here, and when it got up into these levels, it basically was at the 625, 630 level when it comes to price. Was an opportunity to perhaps take some off the table. So again, if it's my portfolio, I would be watching for a return of this type of condition, while at the same time watching for that death cross situation to develop. Nowhere near it right now, but just be aware that if this blue longer term trend turns down and then you get into one of those potential crosses, again, you can have a 60 or 80% virtually overnight drop in the price of a company like Apple. Just something to always be aware of. All right, let's flip to the other side of the question. This one is really cool. Again, this goes back to what Lori was saying about clubs nationwide. The Valley National Bank Corp position in the club's portfolio, a little bit different, a little bit on the smaller side, but a really fascinating opportunity. Chances are they may even either use the company or know people who work for the bank, because it's out in that area or that neck of the woods. And we can take a look at it, and we see basically a good quality company and very decent return forecast. And one of the neat things about Valley National Bank Corp is, when we went through the Great Recession here a few years ago, a whole bunch of companies, especially the money center banks, had very volatile book value. We graph book value for financial sector companies that manifest. The book value for many of these companies did one of these, and it's only now recovering. You can see that throughout that period known as the Great Recession, Valley National Bank Corp actually did fairly well. There's a little bit of a bump down here, but it's almost not even noticeable. So basically the book value of the company, and again, book value, the growth of book value is the way that Warren Buffett measures Berkshire Hathaway. So it's something that we pay a lot of attention to. And then we basically graph the earnings versus the book value. So the difference between these two levels is literally the return on equity. And what you see happening in the realm of banking these days, and this is what's going on from 35,000 feet, is historical levels of return on equity, which had been in the 15 to 20% range going back, have now sort of been replaced by what is possibly some kind of a step change. You can almost see a step change. And now return on equity levels going forward, and nobody knows for how long, are going to be lower. And in this case, you see basically the shift has happened. You see that, like many banks, Valley National seems to be making some progress. And just a real steady story, and kind of a neat thing. Also notice that the price, again, the price followed the earnings. The price trend followed the earnings trend. All right, let's spend a little bit of time talking about context, placing the performance of the portfolio in context, because this is kind of cool. And it probably takes the ladies someplace that they didn't think we were going to end up. Just to give it some context over the longer term, Peter Lynch is legendary for the performance of the Fidelity Magellan Mutual Fund. From the period 1977 through 1990, he generated a return that was 13.4 percentage points above the general stock market. So here's the period in time, again, a 13-year period. Again, 13.4%. It's one of the best, multi-year performances in the history of investing. Hear a lot about Warren Buffett. Warren Buffett over the last approximately 20 years, has delivered a relative return of about 6.6%. The fascinating thing is when you take a look at all 46 years of his investing experience, that number actually is 10.8%. We'll see that here in a few minutes. But again, just placing it in context, these are two of the better achievements, achievements in the world of investing over the last half century. Here's a look at some other points that we can talk about. Basically what we did here is we went out and got some very widely held mutual funds, some fairly successful mutual funds. That's why they're in red, the institutional portfolios. We just kind of splattered them on here. Various levels of years of operation, various levels of return, but notice how very few actually venture up into the top half of this graph. This 5% is kind of magical. That is the objective of most investment clubs, to try to achieve a 5% return over the long term, and again with the full knowledge that achieving anything in this range here is still pretty successful. So our objective is to try to reach for this 5%, but again, if we have to settle for a few percentage points less than that, that'd be fine too. One of the things that we do find is we look at a variety of clubs. Lori's a part of this one. There's a bunch of clubs all around this great country of ours. These blue dots are investment clubs that have done pretty well. This blue dot happens to be a model portfolio at Manifest. Here's that Magellan Point. This is a friend of Warren Buffett's named Walter Schloss, that we'll probably be talking about more and more in days going forward. Now, Dinamat comes in down here over a period that been, again, the accounting records go back about 18 years, 17 and a half or 18 years, somewhere down close to zero. And but what we're not showing you here yet is, again, this is kind of a chart so far that's biased by very successful performance over the long term. When you start bringing a bigger sample size to it, taking a look at more clubs and more individual professional portfolios, this is what you see. And again, if I go out and I add another 100 funds, professionally managed funds to it, 80 or 90% of those funds are actually going to come into this zone. Again, between 0 and 10%. So a bunch of these, we're just going to see an explosion of these red dots, over the years. Very rare for them to end up here. Certainly very rare for them to end up anywhere near Buffett-type levels. But we do see it from some investment clubs. We do see it from interesting things like the Manifest 40, which are the 40 most widely followed companies by our community of investors at Manifest. We think that's kind of cool. In this context, and there's another one we're going to give you in a second, in this context, Dinamat looks extremely successful. It's actually towards the top half of the bubbles, but let's talk about this one here for a second. This data point right here represents the findings of an investment research firm known as Dalbar, where they go out and they take a look at the results actually achieved by groups of individual investors, what we basically refer to as average investors. There are no average investors here this morning. The average investor is the person who chases hot stock tips, hot stock tips from their brother-in-law. They do performance chasing because they buy stuff that's on the cover of magazines. Anybody affiliated with modern investment clubs knows better than to do that. Over the trailing 20-year period, when Dalbar checked into this, they found that the average investor out there actually achieves a relative return of it's actually minus 5.3%, minus 5.3. So again, the average investor out there that is trading far too frequently, chasing returns, acting on hot stock tips, they basically end up down here. So again, all of these blue dots up here, including Dinamat, I count them among the winners. They're basically finding a way to outperform this situation, and they're also outperforming the average professionally managed fund, which ends up somewhere down here. By the way, Bill Miller, one of the most famous examples of professionally managed fund here in recent years, Legg Mason Value, is at a relative return of almost zero. That's after outperforming the stock market for 15 straight years before underperforming it for the last 3 or so. So again, this kind of places things in context. And again, as we deal with more and more investment clubs nationwide, we find the blue dots just ending up in the upper half. And that's cool stuff. Let's talk about one last topic before we open up the floor. kind of wrap things up and talk a little bit about this concept of balanced investing or asset allocation. The Value Line Investment Survey comes out with this reading on a weekly basis, and you can see that they actually have in their recommendations recommended asset allocation for investors somewhere in that 30, 35, 40% range for cash equivalents or treasury issues. So it's a relatively high number. You can see that it's been a little bit lower not too long ago. The reason we talk about it in the investment club context, because again, this is something that many people choose to extrapolate to their individual portfolios, even if they don't practice it in the club, is as you gain experience in investing. You may want to find situations where you use this balanced approach to investing and invest in either non-core, less traditional assets, or actually embrace or deploy the practice of investing in cash equivalents. Again, this is straight from the NAIC Investors Manual, word straight from George Nicholson. You know, what is this balanced investing thing all about? What it comes down to is continue to do all the stuff that you do with our stalwarts or core investments. That's going to represent the core of your portfolio, 75% of total assets, but be willing. Be willing in some cases to embrace some of this other stuff. Non-core as defined by cyclical, perhaps even emerging, promising companies, even cases where low growth. And then also this concept, and that's what we want to talk about here, there are times when this 25% slice can actually be allocated to a fairly significant part of cash. So you could be in a situation where either in a club portfolio when they're willing to do this, or in an individual portfolio where you can have those levels that we showed just a few minutes ago. You know, somewhere up in this range. A little bit stronger than I typically would go, but you can have some in cash equivalents. And why is this important? Why did Nicholson bring it up? Again, think back to the number of times perhaps during your career as an investor, especially if you deploy the stay fully invested at all times myth. That's good for beginning investors, but it's not a very good idea for experienced investors. Think back to the number of times during either deeper corrections or bear markets, and especially in the case of the Dinamat ladies, they've been around for a couple of these market cycles. What about those times when the stock market took a fairly deep plunge? You were fully invested, so you basically wrote everything down. And you got to a point where, geez, everything was on sale. All the stock selection guides looked good, but you had no cash to deploy. And what Nicholson would encourage for experienced investors who choose to do so is to watch for opportunities to basically commit some assets to cash or cash equivalents so that you have resources for buying stocks when they all go on sale. That's really what it comes down to. Now, we want to be crystal clear about this. You don't have to do this. You don't have to do the non-core stuff. You can go 100% core. You'll be all right. Nicholson, however, believed, and I believe it with all my heart, is there is potential. It's not easy, but there is potential to actually gain incrementally better performance from doing this sort of thing. One of the holdings that we find in the Dinamat portfolio is a total return. They actually are using one slightly different than this. We don't cover it at Manifest. I'm going to have to add it to coverage. But just as an example, here's one of Bill Gross's total return bond funds. And in this case, the ticker symbol is PTTRX. The ladies actually have a TIPS-based inflation-protected security fund that looks pretty similar to this. It's a little bit different, but pretty similar. And the thing we want to take away from this one here is, again, think about that roller coaster situation where we ride them all the way back down. You find everything's on sale. That was happening right here. What you see pictured here is the S&P 500 or the blue bars. At the turn of the century, that was a really nasty stock market for a few years. If you were fully invested during that entire time frame, you basically reached a point in time where everything was on sale, but you had no cash. We just had another one here. What you want to notice about the annual total returns from Bill Gross's fund, by the way, he's known as the bond king, during this period going all the way back to I don't know why the years aren't showing up on here. Oh, here we go. All the way back to 1997, there's been not a single year. This is a return basically around zero back in 1999, but basically a positive return even during those really nasty times. So you could have waited out that really nasty market and then gone shopping somewhere in this time frame. Again, if you know what to watch, and we counsel on that at Manifest. Here's another look at it over time. This is why on the ladies' dashboard we show about a 7% projected return for PIMCO. Again, that's his job to take care of the fund. It's a bond fund. But you can see over time, fairly consistent performance, somewhere in that 6 to 8% range. Again, long-term annualized. So some pretty good stuff. It is a potential place. It's an example of a place where you might want to park funds. Let's say you sell a stock and you can't find something that's really attractive, immediate replacement. This is an example of a parking place. And let me give you one more. Within the last several months, they actually have come out with an ETF version of this fund, and the ticker symbol is, unforgettably enough, BOND, B-O-N-D. So if you want to take a look at, go to Morningstar, enter the ticker symbol B-O-N-D. That's a pretty interesting place for potentially parking funds if you want to commit some funds to cash equivalents while you patiently wait for the opportunities to really emerge in the stock market. So with that, and we'll open up for questions, we'll close with our traditional thing. Design your portfolios with sufficient growth potential, return potential, enough quality, and make sure that you're watching for promising smaller growth, smaller, faster growing companies. Monitor those dipsticks. Monitor the status and target ranges. Take action when necessary. Again, in the case of the ladies, not a whole lot needed. Just be watching for opportunities. Perhaps assign somebody to watch Apple carefully for whittling opportunities. Watch for those threats. The death cross is an example of a threat. Other things to watch for are degradation of margins. But most of all, again, captured by their experience going to Paris together, explore, discover, and enjoy. So with that, what I think we'll do is open up the floor for questions or any comments from either the ladies or any of the attendees here. Lori, do we show any questions?
There are a couple questions.
Okay.
I don't know if the club has some first, or.
Yep, go for it.
Okay. There was a couple questions just about fundamental things about using manifests, but one of them was, do you want to just briefly cover how you determine quality of each holding?
Okay, normally we do have a graphic in here. I did leave that out here today. Let's take an example. Let's take one of the holdings that the ladies have. I'm going to switch to manifest. Oh, by the way, that's for those of you that weren't here in the pre-session, that's a photo from what artist did they say they were standing outside his home?
That's Monet's house at Giverny.
Right, and the ladies basically said they visited Paris and Normandy, and there's a closer look at them. That's in our forum. What I'm going to do is grab a stock. Let's talk about one that's in the portfolio. How about Oracle? I'm just going to manifest investing now, entering Oracle. And again, it'll show up, but the reason I did this is I wanted to go to the display on quality for Oracle so that we could talk about the components. We basically score the quality for any company on a scale from 0 to 100, and it's based on these 4 factors. First of all, the financial strength, which is just intuitive. A strong balance sheet, good opportunity capture, all that kind of stuff. Good pipeline, all that is in there. And that's going to range from 0 to 100, and 100 being an A++ rating, a B+ being a 50. So you can see that in the case of Oracle, it's definitely up in the A+ range. The earnings per share stability, that's nothing more complicated than the straightness of the actual results versus the trend line on the visual analysis or the business model analysis. So again, Oracle, even though it's in a fairly challenging industry, fairly consistent, fairly strong results over time. Then we compare the forecasted sales growth rate and the forecasted profitability of the company versus and basically relative to their competitors or peers, and basically build out those 4 characteristics into a factor. Now, anytime that's above 65, as you can see down here from the quality legend, anytime it's above 65, it would rank in the top 20% of all companies. And you can see in the ladies' portfolio from top to bottom, very high quality. If it's in the second quintile, it's still good. And then at the other end of the spectrum, Ford would have been in there, red. So it's basically relatively poor quality compared to everybody else. So those are the components of quality. What else, Lori?
Somebody asked, when you were talking about RSI, I guess something you were talking about, you mentioned an RSI of 14, and they wanted to know if, I guess they want to know a little bit more about RSI, whether you were saying that was high or low.
Okay, the RSI, let's go back and actually look at one of the pictures. I'll tell you what, let's pull it up. Let's take a look at the RSI on, let's take a look at Oracle, because it's near the top of their chart. This is actually a 5-year look at Oracle. Okay, you can see that the price has been a little bit stagnant over the last several months. Here's the relative strength index. The relative strength index, this 14 actually refers to the number of days in the trailing period covered. For a little bit more information on that, it's beyond what we want to cover here today, but what I recommend that people do as they're considering how they might use this is go to the chart school. By the way, stockcharts.com is free. Everything that we're doing here is free. And then just literally enter relative strength index into the search the site at the chart school, and you'll be greeted with a number of articles. This second one down will actually walk you through a tutorial and a description of all the concepts. So how to look at it, how it's calculated, what it means, how you look at it, etc., etc. So you can take and do that. So that's basically what you interpret. In the case of Oracle, remember how we talked about anytime you get above 70 as being potentially overbought? Well, the opposite of overbought is oversold. And you can see that Oracle, down here in prices in the mid-20s, has actually been what you could think of. Let me make this a little bit bigger so people can see it. Basically down in the mid-20s is down in an area which could be thought of as oversold. In other words, potential buying opportunity. And again, what we use this type of information at Manifest Investing for is kind of a trim or a tiebreaker or something like that. We do the fundamental analysis first. We find that it's in the buy zone, that it has a projected return of, let's say, 17, 18%. Then we come here and see this. And again, this is just kind of reinforcement that, you know, there could be support here at either the mid-20s or down around 22. But the relative strength index is indicating that it's in a potentially oversold, potentially attractive situation. Our stock screen, our Sweet 16 that'll be coming out today, it's actually featured in the forum right now, actually treats the subject in greater detail. What else?
Norm Kennitzer was asking, when you were talking about IBM, would you kind of lean towards selling a little bit of it and moving it into something with the higher par?
Well, it's a good question. I don't think I would hurry to do that, Norm. In the case of the ladies' portfolio, what I probably would do is let's actually pull up the portfolio and take a look at it. I wouldn't hurry to do it, but also keep in mind that we saw a technology concentration that was 40% or so. So that is an opportunity to perhaps take a little bit off. If this was given to me and I was making decisions for myself based on my own situation, how's that for disclaimers? I would probably sell half of this position. I'd probably sell half the position in IBM and then seek to redeploy that. And I would probably look really hard at the stuff up here at the top that is not technology. I'm intrigued by Valley National Bancorp. I think I'd study that carefully and take a look at it. I'd even be so crazy as to think about Ford, even though my wife doesn't let me buy Ford in this house. I'd be taking a look at a company like Ford because at a price level down around 10, what I'm showing here is value line. Remember we talked about how that we use that low total return forecast, and here we see a low total return forecast right here of literally high teens, and that just kind of underscores the potential opportunity that we see over here. So I would, I would think about selling. To answer your question, Norm, I think about probably first start with half of that position, and then think about probably Ford, even though this is a little bit low, or Novartis is a bit compelling, even though that's a bit of a higher position. Valley National Bancorp as potential targets. If nothing else, moving it from International Business Machines, which is in technology, moving some of that to Oracle, and this is true for Apple too. If it was mine, I'd be more comfortable, even though I'm staying in technology, of redeploying that into Oracle. Even though I'm staying in technology, I'm getting a higher return and more growth. Any other questions or comments?
I don't see any.
Pretty good on time. We generally try to bring these in at 75 to 90 minutes. We're doing okay. Does anybody else have any questions before they want to get out there and start their gardening or their weekend?
I guess Nancy or Mary, do you have any specific questions?
He's answered many of our questions, and mainly about Apple, because we're very concerned about the percent of total of our portfolio being so high in Apple. And that was a big question for us, because some of our members, really want to hold on, and some of us want to, sell part of it.
Yeah, and it's a tough one. I know Lori struggles with this one too. She's an Apple addict. We're trying to get her treatment. She's she deeply admired Steve Jobs, and I think she's just moved that affection over to the new guy, Tim Cook.
Yeah, that's my new hero.
Yeah,
a lot of clubs are sitting at this exact same question, including mine. It's not an easy question. And I guess, when you were showing your death cross stuff, Mark, to me it was a little bit misleading. I mean, at that point, the whole market pretty much did a nosedive. That wasn't an Apple specific.
Yeah, but it went down.
Necessarily.
It went down 60% at a time when the average high quality stock went down 20%. So I hear you. I agree with you, but I'm just saying that it's the type of vulnerability that you can't ignore. There is an elevated vulnerability.
I don't know what its PE ratio was prior to that. Do you? Still pretty low
to that,
like it is now?
Well, yeah. One of the neat things you can do if you're asking PE type questions, I love this one. You can obviously look at your guides, but you can also go to Morningstar, type in valuation when your company comes up, and you get an interesting little graph. This one is really skewed by whatever happened back here, but to answer your question, Lori, got up into the 40s back in probably late 2007. It's too bad that 2002 is in there, because it really aggravates that. No, that's a tough question, and again, let me emphasize for the ladies of the club, when I talk about this, I can't overemphasize. If it were mine, I would be extremely patient about whittling. If you ever run into anybody that tells you that you have to immediately run out and sell 15% of total assets to get that back into the 10% range, it's probably not the best advice. You don't have to hurry with this sort of thing, but again, if it were mine and I was faced with this type of a situation with potentially overbought, that is an opportunity to do some corrective action, from my perspective.
One of the companies we are struggling with is Siemens.
Okay.
I mean, we've lost quite a bit with it. We keep reading that it's a very good company, etc.
Oh, it is.
But do we keep holding on to it? Do we buy more because it's so low?
That's a great question. In fact, I almost brought this one up. In the current updated manifest, this number that you see here, that's 0.4, will actually go up to about 3 to 4%. So it's actually about a 3 or 4% growth company. You know, you can think of Siemens as one of the General Electrics of Europe, and think of it that way. And the operating phrase there is Europe. They are in a recession over there, and this is the type of company that probably will be sluggish coming out of the recession, but probably is pretty well positioned to take advantage of future growth in Europe, and literally all over the world. Siemens is an absolutely global enterprise. Siemens is also one of the companies, if you guys didn't know this, has been added to coverage in the value line. And this gives you part of your answer here also, in my opinion. It's probably not one I would rush to sell. It's a powerful company. It's impacted by the recession, but it's probably worth hanging on to. Notice that the price has come down quite a bit, but it's probably not time to think about selling it. If you take a look at it using that same methodology we had a few minutes ago, let's take a look at these guys and see which end of the spectrum they're at. And what I think you're going to find, in fact, let's take a look at just 3 years. What we probably find is they're actually at the opposite end of the question you asked. It's probably not time to sell it unless there's some type of a tax benefit. And again, that's something that Lori works with investment clubs all the time. If there's a tax benefit of selling Siemens at a loss to perhaps offset a gain in something like Apple, that can be a combination strategy that makes some sense. But on its own merits, it's actually oversold. It's actually down where it's somewhat attractive. It's kind of down at a support level. If it were mine, I would hang on to it, grit my teeth, hope for a European recovery, but literally begin doing that same thing, you know, watching for it to take off and deliver one of these type of opportunities if you wanted to get rid of it at some point in the future.
But you wouldn't buy more?
How much of the portfolio is it? It's 3.6. That's actually a pretty good stake. No, in my opinion, there's other companies in front of it in line.
Okay.
I'd be much more comfortable, even with the turmoil in the banking industry, with Valley than Siemens. But it looks decent. And again, those more at the top of the list, you're between your oracles.
Or with Ford rather than Siemens. Is Siemens automotive?
Siemens has some automotive practice, but it's not a real big part of the business. They really are a lot like General Electric.
Yeah.
You know, for everything from health to power generation to industrial components. It's a great company. It is absolutely a great company, but it's a mature company also.
We sold GE and bought Siemens.
That's right.
Yeah, and depending on the timing of that, could be a very powerful thing. I don't know what I think today. I can think of a time in the not too distant past where I would have been inclined to do the same thing. And they're both good companies. And since you guys are from the New York area, you've got to like General Electric. Any other questions? Like I said, well, again, we want to close by, again, thanking the ladies for not adopting the witness protection program, but and sharing your episodes and your experience with us. Again, like I said, there are so many lessons in this portfolio that people will benefit from. We really appreciate your sharing and reaching out, and wish you the best of luck going forward. Just keep doing what you're doing. Get out there and discover a couple promising small companies along the way, perhaps, but you guys are doing awesome, and just keep up the good work. And as we mentioned earlier, Lori and I are willing to stow away if you're headed for some exotic place.
Yeah, please let us know.
But again, thanks for allowing us to visit with your portfolio.